Okay, we're starting with some overview concepts about financial accounting. And so I'm going to share my screen and work through my lecture notes, and those notes are posted in Moodle. Okay, so the first thing we're going to talk about before we get into the actual material is the need for ethical behavior. When I talk about accounting, I always like to stress the fact that we need ethical behavior in accounting, because as accountants get more educated and they go out into the workforce, they get a lot of authority handed to them because they're the ones who know how to take care of the books and manage the financial statements. So there's actually a lot of responsibility on the accountants, and there's also a lot of opportunity for accountants to either represent properly or misrepresent the financial condition of the companies they're doing financial statements for, and or the companies they're auditing, or the individuals they're doing tax returns for. There's a lot of opportunity for accountants to do what is right, but that means there's also the opportunity for some shenanigans to arise. And over the years, there have been quite a few lapses exposed in that accountants have made bad choices. And so I want to make sure that you understand that it's very important that you uphold high ethical standards when you do accounting work. Okay, so there's three levels of, three factors or three levels of what I call deterrence to doing something wrong. And so the one that gets the most public awareness is the laws and enforcement. And that is the rules that are out there that say, if you do these things wrong, you can go to jail. The SEC catches you reporting financial statements incorrectly, then that means they could prosecute you and send you to prison. And so the ethical behavior that most people think of is the things that would get you put in jail if you don't do the unethical behavior, I should say, that most people consider the most prevalent are the ones that you would go to jail if they caught you doing this. And that is true. That's the most unethical of behaviors, of course. But the problem is the oversight organizations can't look at every transaction that everyone does. So that level of deterrent to doing wrong is not actually the most effective of all the deterrents for unethical behavior. So yes, you could go to jail, but most people get very comfortable if they're doing something wrong because they know that they might not get caught. And so that is sort of a weak deterrent compared to the others. So then the next level of deterrent that's a little stronger is what I call a firm culture, where that's where if you work for a company or like a CPA firm or a corporation, and there's a culture within that organization that won't tolerate these unethical lapses. So if the company was aware that you were doing something that's unethical, that would be immediate grounds for them to terminate you. So that'd be a little more risky for you because that would be, you could lose your job or you could ruin your reputation or both. And also others that work with you could see this unethical behavior and report you. So there's a lot more risk that you would get caught in the organization you work in than there is that the government or, the law enforcement would catch you doing something wrong. And so the firm culture deterrent is much stronger than the laws and enforcement deterrent for doing wrong. And so, I feel that it's pretty strong in that others that you work with are most likely able to see what you're doing or be aware. But there are cases where individuals are allowed freedom, probably too much freedom, where they could do some unethical behavior and misrepresent the financial statements or the tax return or the audit. And others in their organization might not realize it because they weren't actually being reviewed. Their actions weren't being reviewed adequately. So it's a little weak as far as a deterrent goes, but it's much stronger than law enforcement. Now, the strongest of deterrents is the third one I'm mentioning, which is individual character. So that one actually is foolproof. If your individual character keeps you from doing wrong, then it doesn't matter if you would have gotten caught by your peers at your organization, or if you would have gotten caught by the law and enforcement, because if your individual character stopped you from doing it, you're not doing anything unethical. So that would be the strongest deterrent. And that's my suggestion, is that you need to consider what is right and what is wrong, and choose right. Draw a line in the sand and say, okay, I'm not going to cross this line. I know that's not right. You know that's not right. So that's just where my stopping point is. And so I encourage you to always keep in mind when you're working in accounting is that don't compromise on the little things, because those things kind of tend to lead you into compromises in larger matters. Okay, so you just choose to do what's right out of individual character and take the higher road. And so this is just really important. And I wrote a little bit about it in here just because I want to make sure that you understand the significance. Okay, so let's just start talking about some of these overview concepts in accounting. One main thing that we like to teach in this early chapter is that there are several different kinds of businesses. Some businesses don't make a product at all. They provide a service, and that's service organizations. So we'll study those for the first few chapters, and then we'll add some information about companies that are merchandisers. And those companies buy a product and resell it to their customers. And so they have a few more factors, but add some inventory issues and things like that. But they basically still account for everything the same way of service merchandisers. They just have this added factor of having the product bought and resold. Then there's the manufacturers, which are a little more complex in that they make the product. They take raw materials and turn it into a product. Now, most of the study that we'll do of manufacturers is going to be in the next accounting course, or if you did the courses in reverse, it would be in the managerial accounting course. So, but in any case, the manufacturing is covered in a totally separate course, and it's also covered in cost accounting because it really is a more in-depth accounting that's viewed from the internal to the corporation angle. So that'd be the three major kinds of businesses: service, merchandise, and manufacturing. And then there's different organizational forms that the company might take. In this course that we're going to be studying, we're going to looking at the corporate form of organization, but there are actually other ways you could organize your company. So you could be a proprietorship, where you just own the company as one individual owning a business. This is what some people call a mom and pop organization, but it could be a huge organization that is just not incorporated. But in any case, it's just one individual that owns the company. And then if you have several people that own a company together that's not incorporated, that would be called a partnership. And so usually, now it could be other forms, like an LLC is a limited liability company that is sort of a blend between a corporation and a partnership. And so most of the individuals that just form a partnership with other individuals would just do it as a general partnership. But you could do a legal document where you limit the liability of each partner by making it an LLC or an LLP, which is just a limited liability partnership. Now, in some courses we take in business, you'll learn more about these. But for this course, we're going to just focus on accounting from the standpoint of the corporate organization, because we have to choose one, and that's the most prevalent one because of the fact that we generally accepted accounting policies are generally geared toward corporations. And so that's the way that we will tackle the course. Corporation is an organization that has a life of its own. It's like it's an individual itself, but it's a corporation. So it is an entity of its own. And so when you own shares in a corporation, it's not that you own the underlying assets, it's that you own the corporate shares. So you own a piece of the corporation. You still could have an individual that owns all of the shares of a company. So like if you're a CPA, you might have just a single proprietorship running, but if you wanted to, you could set it up as a corporation so that you would own all the shares, but it would operate as its own legal entity, and that would be an actual corporation that would file a tax return, and then the shareholder would report a portion of it if it was a S corporation, or would just only report if they received dividends if it was a C corporation. So in another chapter later in this course, we'll talk about all these things about corporation, or a lot of the things about corporations and how to report for them. But from now, I just want you to know there's a lot of options about how you can set your company up, but we're just going to talk about corporations mostly. Okay, so then there's internal or external users. External users is what we are when we look at the financial statements of corporations like Coca-Cola or Pepsi or Apple computers, Microsoft, any of these big corporations that you've heard the names of. When you look at their financial statements and you are trying to decide whether to like buy some of their product, or whether to go to work for one of these companies, or whether to buy some shares in the corporation, all the things you're doing when you look at their financial statements are external uses of their financials. So we can see their financial statements by just Googling or looking on DuckDuckGo or any of the other search engines and just typing in the company name and financials. And you're going to come up with a lot of information about the company that you can see as an external user. And so external users could be investors, creditors, the government itself, customers, suppliers. So a lot of times if a company's trying to decide whether to do business with another company, they go online and look at the financial statements for that company they're considering working with. So that's really smart business, but because the information is readily available and you get a lot stronger view of how stable the company is, so that you'll know if you're going to have an interruption later if you're using them as a supplier, or so that you'll know whether they're going to continue to need your product that you're supplying. If they're stable and have a good track record of history, and all these factors, you can consider a lot of these factors just as an external user. And I suggest that you do. If you ever try to go get a job at Google, you should research the company and look at their financial statements over the last 5 or 10 years and see how they're trending. So that kind of information is very useful to everyone. Plus, of course, if we're going to invest in a company, if I'm going to buy some shares in Google, it's actually not called Google, it's called Alphabet. But if I wanted to buy those shares, I would say I should spend some time looking at how they've done over the past few years, so I'll know if they're trending well or not. Because I might be throwing my money down the tubes if I'm investing in a company that's on a downward cycle, right? But in any case, that's not part of our course, but it's just trying to explain to you what an external user is. Okay. Internal users, on the other hand, are the people inside the corporation that were making the decisions about what the company should do. So if the company is like a company like Levi Strauss, they're trying to decide whether they want to make more jeans or more khakis. They want to branch off into something besides pants. They want to go open a new line of some kind of product, but internal to the company, they have information that's not readily available to outsiders. So that's how they make decisions about what to do next. And so that's the management and the board of directors, as well as the employees. Okay, accountants provide information to both sets. So there's internal accountants that provide information to the internal users. There's independent accountants that provide information for the external users, or at least review the information that's prepared for the external users. So you would see accountants in every strata, every business, because you have to have accountants to keep things straight, so that whenever someone looks at the business, whether it's an internal user or an external user, they can have confidence that these numbers are right, or at least they're reasonable. And so that's why accountants are really critical to a lot of different businesses. There are two basic areas of accounting that an accountant might work for, and that would be private accounting or public accounting. Private accounting is those internal accountants mostly. And so that they work for one corporation usually, or for one or two, but they don't generally work for a lot of different companies. Whereas public accountants work on a fee basis for a lot of different companies. So they might do tax work for a lot of individuals, or they might do audits for several different companies. They might do management consulting activities, or they could even do IT activities. So there's a lot of things that accountants can do on the private area, in the private accounting area, or on the public accounting area. So either one of those, there's a lot of doors that can be opened if you have an accounting. So if any of you are considering being an accountant, let me tell you, there are plenty of opportunities for work in this area. Okay, so now let's just give you a little idea about financial statements. Financial statements are the reports that we do that allow people to make decisions about the companies. So it's sort of like the information you get from sports activity, like baseball, for instance. There's a lot of stats that are accumulated about each baseball game. So if your favorite team played a game this weekend and you had to be out of town at some other event and were not able to watch the game or go to the game, then you maybe would be interested in looking at the stats. That's because if you just look at the end score of any ball game, you would think, well, that's terrible, we lost, or that's wonderful, we won, but you wouldn't really know what happened. So that here's the score is only good enough for people that aren't truly invested in the game. So if you really are invested in the game, is this like your team? Then you want to know a lot more than what was the final score. Because when you see that final score, you're like, what? Why is that? Why would we have lost? We beat that team so many times in the past. So, or you would say, wow, how in the world did we pull that off? I thought for sure they were going to beat us like they did last time. And so you don't really know what happened when you just look at the final score. And that's what happens in accounting too. When you look at the final balance sheet of a company, you can't really tell a lot about it just based on that, or just the income statement. You can't tell what is going on with the business just by one single statement in the financial statements. And one of the pieces of the puzzle is not enough. You need all the information. So if you miss that ball game, you got to look at several different things. So in baseball, you might look at the pitcher data, look at the earned runs, look at the batting average and the stolen bases, plus looking at the overall final score. That's going to, once you look at all those stats, you're going to have a lot better idea of what happened and why that game turned out the way it did. And that's the way it is in accounting too. You take all the financials together, you take the balance sheet, which shows the ending value of all that the company owns and owes to others, and the equity that the investors have in it. And that tells you something. But when you add to that the information from the income statement, which shows you what happened this period, how much revenue did we earn, and how much expenses did we have that offset that revenue, that gives you a better idea now if you look at the two of them together. Then if you look at, well, here, how much did we retain after we paid dividends? The retained earnings statement helps with that. And then the cash flow statement shows how much cash do we have at the beginning of the year and how much at the end, and what changes happened during the year that made that cash fluctuate from the beginning to the end. So all these things together give you a pretty broad view of what's happening to the company. Then if you throw in some notes to the financial statement, they give a lot of information about each major transaction. You're getting a lot bigger picture of what's happening to this company. Okay, so I just mentioned these financial statements. There's 4 of them total. What's noteworthy is 3 of them are talking about a period of time. The income statement usually is talking about a year. So if you're talking about, if you happen to be in the year 2021, then you might be looking at a financial statement for the year 2020. And so that would mean that you're looking at for the period of the year January 1st to December 31st, if it's a calendar year, of the year 2020. That would be an income statement showing all the revenue and all the expenses that offset that revenue. That's the income statement. It's for a certain period of time. So it could be for a year or a month or a quarter, but normally you think of it as being a year when you look at financial statements for companies. Then the retained earnings statement, that starts out and shows you what was the company's retained earnings, how much have they earned and kept at the beginning of the period, and then how much did they earn this year, the net that came from that income statement. And then of that, once they had their previous year's earnings and this year's earnings, if they paid out some dividends to their shareholders, then how much was left after that? That's the retained earnings statement. Also, for a period of time, it would be for that year, 2020 in this case. Then the third one is for a period of time is the cash flow statement that shows the difference between January 1's cash and December 31st's cash. This is assuming a calendar year again. Then that would be showing you, why did the cash change? The net income or the income statement bottom line is part of the reason it changed. But then what other factors came into where the money go? Where did it come from? So a lot of different things can affect cash, like borrowings and paying back borrowings, and also buying land or equipment. A lot of things affect cash that you don't think of originally. So you need to consider cash flow as more than just what did we make this year. So those three are all talking about a period of time. But there's one statement that's different, and it's talking about what are the values for this company at a point in time. And that's the balance sheet. The balance sheet shows as of the last day of the period, which in this case, we were talking about the calendar year would have been December 31st. So what were the balances that we had in the bank? How much was the value of our bank account? How much was the value of the assets that customers owed us? How much was the value on our balance sheet or on our accounts for land and equipment? How much did we owe to other people? Accounts payable and notes payable. And then how much equity was left that our owners could claim. So all that one, the balance sheet, is all as of a certain day of the year, which is the last day of the year, last day of the month, last day of the quarter. So basically the last day of whatever period you're reporting. So that's the one that's different, the balance sheet. The income statement, retained earnings, and statement of cash flow are all for a period of time, whereas balance sheet is for a point in time. Okay, each statement shows different things. The income statement, for instance, shows the revenue, which is just talking about how much did you sell your product for. Then the expenses, the cost that it took to produce that revenue. And then that brings you to what's called the net income. I left out the gains and losses because we really focus on them later in the course. But if you had gains from sales of property, those would not be directly related to operations, but they would be extra gains. And then also if you had losses from the disposition of assets that are not part of your operating ongoing operations, that would go as part of your net income also. But these gains and losses we'll discuss later in the course or in an upper level course. But for now, we just think of net income as being revenue minus expenses. Then those things are reported, net income, including revenue and expenses, reported on the income statement. Then on the balance sheet, everything the company owns is called their assets. So assets is a term that means whatever the company owns, resources that the company has that they can use to make money in the future. So that would be like their bank account, the equipment, land, buildings, anything they have that is going to be turning into cash later or that can be used to help produce some income. So those are all called assets. So that's one side of things. Then on the other side of the things, we've got liabilities and equity. Liabilities are anything we owe to outsiders. So it's going to say something like payable or due normally. So liabilities are owed to outsiders. And then equity is common stock, retained earnings, and other contributed capital, which we'll learn a little more about later when we get to a later chapter. But right now, we'll be looking at common stock and retained earnings. It's about the only thing that's going to be in the balance sheet equity section. And so that balance sheet we'll talk about that some more in a little bit, but the balance sheet always balances. That's why it's called that, because assets equals liabilities plus equity. So we're going to focus on that some more later in this same lecture. All right, then the retained earnings is basically taking retained earnings, which is that revenue minus expenses. Retained earnings is taking net income, which is that revenue minus expenses. And we either are going to keep it in the company, like keep it in our own, in the company's control, that's called retaining it, or we are going to pay it out as dividends to shareholders. So sometimes you give a dividend back to the investors, and that decreases your retained earnings, because retained earnings is just what it sounds like. It's the earnings that we've made and we didn't pay out. So we kept it in the company. Okay, so we'll work through a lot more about these later. Don't worry, just take what you can take and just let it go at that. I interspersed some exercises in this lecture format so that we can do some exercises to try to get comfortable with some of this. So this first one, these exercises I pulled, by the way, are coming from the open educational resource, Openstax. And it's a free resource that you can actually find on the internet if you want. There's a link to it at the bottom of my lecture notes. But these are coming from chapter 3 of that free textbook. And the textbook is has some exercises that I pulled from chapter 3 that I'm going to integrate into this class, into this lecture particularly, and into a couple more lectures coming up. This one, though, is EA2. And it said, consider the following accounts and determine the account, if the account is an asset, a liability, or equity. So we're just going to use the ALE. So equity would be any kind of, it would, for right now, since we're only classified in 3 ways, asset, liability, or equity, equity would include revenue and expense, because ultimately they are part of equity. Okay, so accounts payable. Remember, I told you liabilities are always going to say, not always say, generally are going to say something like liability was going to say something like payable or due. And then cash is an asset. It's a resource of the company. Dividends. Now, this is something we haven't discussed what type of account it is, but dividends is that payment we're making to the investor to give them part of the money back. So it's part of the equity section. And then notes payable is, it says the word payable, so you know it's a liability. Carrying on with some more of these same ones, accounts receivable, that's an asset that represents amounts that your customers owe you. They're going to pay you later, even though they've already made the sale, they've already got their goods, they are going to pay you later. Then sales revenue goes on the income statement, and that means it's part of equity long term. If you have to pick between asset, liability, and equity, that means all revenue expense winds up being equity. Land is an asset. It's a resource the company owns. Here's another one. Here's one we haven't talked about yet. Unearned revenue. Unearned revenue is actually a liability. That's when a customer pays you in advance. You're holding their cash, but you can't show it as revenue yet because you haven't done the goods. You haven't provided the goods yet, or the service. So unearned revenue is actually a liability. And it's not that you owe money back to your customer, it's that you owe them the service or goods. If you don't deliver the service or goods, then you'll owe them the money back instead. So you owe the customer something, this because they paid you in advance, unearned revenue. Okay, so here, let's go just a little further, a few more of these. This one is talking about identifying the financial statement on which each of these would appear, the income statement, retained earnings statement, or balance sheet. So we use the initials for these. Insurance expense, we know all revenue expense shows up on the income statement. That's where we'll put it. And then accounts receivable, an asset, it's going to go on the balance sheet. Office supplies, if office supplies does not say the word expense with it, then that means that's talking about an inventory of office supplies that's in your, it's an asset that the company owns. They have in a storage closet somewhere. You know, that's just a small business way of referring to it. Could be a huge inventory of office supplies, but I usually think of it as on a small business scale. It's usually some supply cabinet. Okay, sales revenue, that's an income statement account. I'll turn everything red. And then common stock, that is the account we call when we issue stock, as in a company, when an individual invests in our company, they give us cash and we give them common stock. And so we record a payment, a receipt of cash in exchange for common stock with an entry to common stock, which stays on our balance sheet to show that we've issued shares to these individuals. Note payable goes on the balance sheet because it's a liability. So once you play with these a while, they start becoming more and more familiar. You don't have to know everything today. You just work on it. You just let it land. You just keep working, and eventually it starts to stick. So it's nothing to freak out about at this point. All right, so here's another thought I want you to consider. When you think of the fact that assets equals liabilities and equity, there's a reason for that, because the company has all these assets and there's a claim on the entirety of the assets. So this whole asset bunch that we own, if I could highlight just the box, that'd be nice, but nope, it's not letting me. The assets themselves are the total. Like if our company, look, for instance, this example I've got here, I'll just highlight this so we can talk about it a little bit. If the company has $700,000 worth of assets, that means everything they own is in their asset list. All the resources the company has. Excuse me. And of those resources, there's a claim on every one of them. That's because they owe creditors usually. So if you owe creditors, that's a liability. So the part that the creditors own, there's a claim on the assets regarding the amount that you owe the creditors. And then everything else that you own, that the company owns, the owners have a claim on. So when you have assets of 700,000, if the creditors are owed 150, that means the owners have a valuation of the remaining 550. So if you were to dissolve the company and you had $700,000 worth of assets and you owed creditors 150, that just means you would sell the assets that were 150,000. You would sell enough assets to pay off those creditors at 150, and you'd still be left with assets that were worth $550,000. That's just if the company's assets were worth the same as the values that were reported on their balance sheet. But basically what I'm saying is every asset the company owns has a claim on it. The creditors have the first claim. And then once they're paid, the owners have a claim on every other asset. So you couldn't just come along and say, oh, I'm the manager of this company, and if we're going to dissolve this company, I'm just going to take all these assets home with me, because that is not your assets. The owners that own the shares, they own whatever's not owed to the creditors. So you would just split up all the remaining assets amongst the owners after you've paid the creditors off. So that's just something you need to realize. That's why the accounting equation works, where it's assets equals liabilities and equities, and it would never not be that way, because any amount in assets that you have a claim on them. Either those creditors have a claim on it or the owners have a claim on everything else. Okay, so now let's see a term I want to make sure you know. The words profit, earnings, income, even net income, they can be used interchangeably. The term net income and the term profit are very commonly interchanged in the common. I mean, if officially you should use certain names that are on the official balance sheet, income statement, all the different statements, that financial statements that we have that we for according to GAAP, generally accepted accounting principles. But in practicality, the term profit is interchanged with net income very often. And then the assets that a company has, another term for those is resources. And that's just everything the company owns. Claims includes claims of the creditors and of the owners. So liabilities and equity is claims of the creditors and claims of the owners. So that's what the creditors are, the outsiders that are not the owners. And so assets and equals liabilities and equity, it's a scale that balances, and every time you change the asset amount, it automatically changes the liability and equity total. So if you know one of these things, you can find the others. So assets equals liabilities plus equity. So assets minus liabilities equals the stockholders' equity. So this is just using a little bit of very simplistic algebra and rearranging the accounting equation. So you know how algebra works. If you have assets equals liabilities plus equity, you know that that's the same thing as just subtracting liabilities from both sides. So that would give you assets minus liabilities. I'm just going to change this color on one side. And if you subtract, if you had assets equals, let me scoot this over so we can see in line where that equals sign is. Okay, if you had assets equals liabilities plus equity, which we always do, then you know that that's the same thing. If you subtract liabilities from both sides, that means you could say, by the same token, that assets minus liabilities equals stockholders' equity. Because when you subtract liabilities from both sides, you wind up with only stockholders' equity on the one side and assets minus liabilities on the other. And by the same token, if you know your asset amount and you know your stockholders' equity amount, let's go ahead and change this one just a little bit to a different color. You could subtract stockholders' equity from both sides and also come up with something. So let me move these over one more time because I'm trying to find a way to get them lined up. I'm going to move this one to line up. Okay, if you, instead of subtracting liabilities, if you subtracted stockholders' equity from both sides, you would wind up with assets minus stockholders' equity on one side, and you'd wind up with just liabilities on the other side, right? So this is how you know you can isolate what the answer is when you've got a missing pieces for a problem like this. See how assets, if you know assets is 865,430, and you know equity is 759,121, you could just use this thing right here. Assets minus stockholders' equity gives you the liabilities. You know that assets is equal to liabilities plus equity. So you can just take assets and subtract equity from it, and that will give you this answer to the liabilities. 106,309 is your missing piece right here, isn't it? I'm sorry, well, let me put it in there. So, because if you took assets equals, and then you added 106,309 to 759,121, it would also equal 865,430, right? So that's how you can manipulate to see what the numbers are. I got a few more of these. If I know that assets is 1,150,000 and liabilities is 588,000, then I can easily find equity because I know that liabilities plus equity equals that asset number. So I'm just going to subtract liabilities from asset amount, and I'm going to come up with how much is left. That's got to be my equity, 562,000, right? Okay, here's another one. It's exactly the same thing. If you got these two companies, they give you the asset amount in both cases, and there's a missing piece. On Gianni, there is a missing liability amount, but they gave me the assets and they gave me the equity, so I know how much that liability total is. And the same thing with Forrest. They gave me, you can eyeball this one very easily. They gave me assets of 387 and liabilities are 7. That means I know that the equity is 380, right? So let's go ahead and show these. 380 is the missing piece for Forrest. For Gianni, it's 75,000. Because if you take 75,000 and add 147, you're going to come to 222,000. And the way you would calculate that, of course, is just write it in the format of algebra if you want. 222 equals X plus 147. You could use the thousands if you want, but if it's all round numbers, you just can find out how many thousands are different. And you're going to come to the result of 75 as your difference, right? So here's another one. Now on these, when I do multiples like this, anytime you're watching my video, you can pause it and do the calculation yourself. And that way you'll know if you're correct or not. You'll know if you're thinking correctly. So this one, I forgot to hide them. These two are the results for this one. How much is the total assets for Elias? If liabilities is 33 plus 186, just add them, liabilities and equity together, and you know how much assets are. Same thing on Patel. You know assets is 125 and you know equity is 63. So that means you know for sure that liabilities is 62, because you know it takes 62,000 more to add to 63 in order to come to your total of the assets. All right, the next one. This is a little more complicated, but it's not hard. It's the same principle. This one says assets is 246.3. We don't know what the liabilities are, but equity is a combination of this 160 in common stock, dividends of 30, revenue of 245.8, and expenses of 175. So what you're going to do with this one is you're just going to find out you got assets, you're going to find out what the equity number is, and that's going to help you to be able to have the same problem we've had all this time. So what we do is we say 246.3 is the assets, and equity is 200,800. And then you arrive at that by saying, well, common stock adds to equity and revenue adds to equity. So when I add 160 and 245.8, that brings me all of the additions that added to equity. And then expenses reduced equity by 175 and dividends reduced equity by 30. So if I take 160,000 plus 245.8 minus 175,000 minus 30,000, I come up with equity of 200,800. So now once I've got to that point, it's exactly like these problems I was working earlier. So it's 246.3 minus 200,800. And so there, I can now solve it to see what the liability amount is. So reveal it there. The liability must be 45.5 because that's what it takes to bring the liability and equity side up to 246.3. You see? Okay. So this is another one that's similar to the same. I'm not going to spend a lot of time on this, but if you want to practice, what you do is just pause again at this point before I reveal the answer, and you calculate what you think it is, and then you check it by the response I'm about to give you. Okay, so I'm going to go ahead and do it. This one, I don't know the assets in this one, but I know that it's the total of the liabilities and equity. So I have to calculate. I have the liability amount of 110.5. The equity amount, again, is a combination of the common stock plus the revenue minus the expenses minus the dividends, because revenue and common stock both increase equity and expenses and dividends decrease equity. So when I add 60,000 plus 785,000 minus 234,750 minus 15,000, that brings me to equity of 595,250. So if equity is 595,250 and liabilities is 110,500, that means my asset total has to be 705,750. Okay. So there's in each chapter, they add some concepts that we need to learn something about. Generally accepted accounting principles, or GAAP, is sort of like the rules that control ball again. Sports is one of those things that a lot of people know about, and you understand that a lot of times, even if you've never understood anything about accounting. So the part that I want you to get about this is GAAP is very similar to the organizations that control football and baseball and basketball. So in high school, that would be like the High School Athletics Association, or in college, it would be the NCAA, and so it's on and on. Whatever level you're at, there's an organization that controls the rules. So it's an agreement of the parties that are in control. So there'd be these people on the board that would decide what's going to be the rule. So many years ago, there were different rules for football than there are now. And so there would be a lot of different rules that have changed over the years about how long can the overtime be, what is the methodology of doing a football overtime set. And so the same thing with a basketball. There used to be that the free throw lines were in different places that they are now. So the reason they changed is because the people that were serving in positions on the regulatory boards for those athletic associations, they would have a discussion, and some people on the board would be strong-willed about, that's not right, we shouldn't be measuring that way. And so then they would have a discussion, and sometimes they would convince the entire board that you're right, we should change that rule. And so that's exactly what happens with GAAP. There's these people that get appointed to the generally accepted accounting principles to the board for accounting that make these changes that the general public can't, or even general CPAs that have the right to practice as a public accountant. They can't just go change the rules. They can't even petition really to change the rules. They can contact the oversight board and decide, the FASB, the Financial Accounting Standards Board, and try to encourage them to consider this concept, but they can't make any changes themselves. The FASB board or the GASB board, in the case of governmental accounting, can make changes based on what those board members think are important. And so it's a consensus of the party that are serving on the FASB board. That's who can make changes regarding rules for accountants. And once they do, then those rules are effective for all of us. Now, they are required to take some, if they make big changes, they're required to take comment from the public and from CPAs, but by and large, they are in control of the changes. Okay, hang on. Excuse me, sorry. And some water. Sorry. Okay. Now, one of those concepts is the entity concept. We're just going to pick up a few from each chapter. If there's 3 businesses, they're supposed to be kept separate where you can track what's going on in the businesses. And a corporation is kept separately from its owners. Partnerships are kept separately from their owners. So separate entity assumption and business entity assumption concept is the same kind of thing as saying, don't integrate these with your personal activities. Then the unit of measure concept, that is the concept that says we should always record in our US currency. If we did a transaction in another currency, because the global environment says that we do sometimes buy and sell in other currencies. And if we do, we convert it to US dollars before we record it in our books. And then the objectivity concept is another one I'll bring up this time. It's based on objective evidence. And basically that is sort of like, if this evidence is there and it's clear to anyone that would look at it, or to educated people that would look at it that are aware of the circumstances, would interpret it the same way. So it's not just conjecture that we're making something up. So that's just a few concepts I'm dropping in this time, and we'll add more as we go along, accounting concepts or principles. But I want to make a caveat. We don't want to try to force this to all make sense all at one time. Just pace yourself, listen to it more than one time, read through the book, make sure you're seeing different angles of it, and it'll start clicking and making sense. Just take what I say. Don't try to question whether I'm telling you something straight or not. Just for now, just try to accept it and say, let me try to understand this. And I'm not saying I'm never going to be wrong. You certainly can let me know if you see something I'm saying that doesn't seem to be right. But I'm just saying a lot of this is by its very nature going to be foreign to you if you've never been exposed to it. But once you understand it, then you'll be able to keep going and building on what you've learned. So just try to take it at face value, build something else on it the next time, and then we'll work through it until you understand. And you can repeat until you understand. You can look at other sources, but just try to be calm. Just try not to get freaky on me, and just try to just take it at slow and easy. Just, okay, all right then, if you say so, until it makes sense. Then once it makes sense, you're like, oh, of course, nothing to it. You can do it. Okay, and there's where I'm just giving you the link to the open source resource. If you care to look at that, you can. Not doing an endorsement, just I'm using them because they were good practical examples and I was involved in building those. Okay, so I'm going to leave it for that for chapter 1, and I will start another one for the next chapter. I didn't record it.